Here with Fidelity Institutional Asset Management here today. For those of you who have been a part of our webinar series, you know that we've had, as we affectionately call him, Nosh, here with us before, and we have a great relationship with Fidelity. And Nosh is responsible for delivering macroeconomic analysis and strategy, and to give investment themes that lead to portfolio allocations and recommendations at Fidelity for the Fidelity product lineup. And so, Nosh, we want to thank you for being here. What we're going to do is spend about the next 25 minutes to the half hour talking about Fidelity's viewpoint, which, by the way, is very much in line with our own viewpoint. So thank you for Nosh giving us this overview. And then at the end of this, we're going to open it up for questions. So with that, and as a reminder, Carissa is kind of coordinating our webinar. So thank you, Carissa, for that. Got John here as well, who is in charge of our investment strategy here at WealthWise, along with myself. So with that, Nosh, we're going to go ahead and turn it over to you for the next 25 minutes.
Thank you, Laureen, and good evening, everyone. And just give me a minute to start my screen share. So let me know if you can see my screen with a thumbs up and we can get started.
We can see it, yes.
So good evening, everyone. And what I wanted to do today is to give you kind of a big picture view of where things stand in the US economy, looking at where we are in the business cycle, what is our expectation of growth, what is our expectation of inflation, where is employment, what are some of the other dynamics that we are looking at, especially the deficit, which is leading to slightly higher than expected inflation, some of the political things that may come about in the month of September. So we'll tackle all of those, and finally, we'll come back to where do we see opportunities in the environment that we are in. So as we've always previously stated, our investment thesis and our asset allocation starts with where we are in the business cycle. So think about the business cycle broken into 4 phases. Now, they are not equal in time. With every different cycle, it's a different time period. For every country, it's a different time period in a sense. But think about the 4 phases as very similar to the 4 seasons of the year. So during the early phase, typically think about it coming out of winter, getting into spring. So the days are getting longer, you stop shoveling your snow. Basically, the economy starts growing at a very rapid pace. Profits are increasing very rapidly. Employment increases very rapidly. Now, once we go through spring, we enter into the summer months. So during the summer months, we stop caring about the amount of daylight or sunlight that we actually receive, because every single morning we wake up, we see clear blue skies. So very similar to that, during the mid-cycle, which typically tends to be the longest part of the business cycle, the economy as well as corporations continue to grow at a very high rate. In a sense, it plateaus out at a high rate in a sense. So that's the period where people are really comfortable saying there are jobs which are plentiful, profits are growing, things of that nature. And then we get into the late cycle. So late cycle is like autumn. So slowly and steadily, the days start getting shorter, and you start thinking about where is my jacket? Where is my winter coat? Do I need to put on some new snow tires? So things of that nature. From an economic perspective, what happens is that corporate CEOs, managers, they start realizing that corporate profits are starting to slow down. So they start cutting back on spending, they start cutting back on hiring. And finally, we get to the recession stage. So during that stage, essentially, which is similar to winter, it gets a little bit dark and gloomy. And from an economic perspective, what we essentially do is try to get rid of unproductive assets. So you start seeing business bankruptcies starting to take place, unemployment starting to increase, and all of those bad things which are a little bit painful. So when I say all these things, typically I get the question, do we really need recession? And my answer is, actually, that is one of the most important stages of the business cycle. And the reason being, if you don't get rid of unproductive assets and you keep maintaining them, you are not going to get new innovation. So if you look at a country like Japan, literally for 3 decades, they just keep pouring more and more money without actually reforming the system in a sense. On the other hand, in capitalistic systems like the US, if you go back to 2008-9, we actually let a few banks fail, a lot of businesses went under, and then we got literally 12 years of very good growth in a sense. So recession is not something to be feared in a sense. And then we'll talk about what kind of a recession that we expect, especially in this cycle. So let's move to our expectations of this cycle. And I'll talk about what Chairman Powell has been discussing. He's the chairman of the Federal Reserve, what he's been discussing over the last quarter in a sense. So the first thing that he keeps on reiterating is that he wants to bring inflation down to 2%. And we'll discuss that a little bit more in detail. Secondly, what he is also saying is that though he expected the economy to cool down in the first half of this year, it actually grew at 2%. And therefore, it has been difficult for inflation to actually come down. So sitting today, we are still growing at a moderate pace of about 2%. And to really get inflation down to about 2%, we may just require a mild, what we call as a soft landing recession. Now, we'll also look at the labor market side of things. Now, important thing to understand. So you might say in the past cycles, when central banks have increased rates, typically inflation has come down. So what is leading to higher gas pricing? What is leading to higher grocery bills? What's leading to higher utility bills? So yes, monetary policy has become quite tight. But what we also see is that fiscal policy remains extremely loose, leading to large deficits in a sense. So we'll explore both of these themes from an inflation perspective, from an employment perspective, as well as from a fiscal deficit perspective. So what you're watching on the screen are 2 lines. The yellow line, what we call as the consumer price index, which is a proxy for inflation. And then the white line is your core consumer price index, which is to say, excluding food and energy costs, which tend to be quite volatile. So when we look at the yellow line, so last June, because of the conflict with oil prices going from $65 up to $130, prices increased very sharply by 9.1%. And then President Biden started releasing oil from the Strategic Petroleum Reserve. So last year, the Strategic Petroleum Reserve was at 650 million barrels. Today, it's come down to 340 million barrels, the lowest that we've seen since the early 80s in cents. So that brought down inflation from 9.1% down to 3% in June. Now it's marginally increased to about 3.2%. But if you look at the white line, which is your core CPI, the key driver for core CPI is always labor conditions. So sitting today with the unemployment rate at an extremely low 3.5%, the labor market remains very tight. Now, firstly, what is causing this? And there are two reasons for it. So one, what we've been noticing now for the last 2 years is that baby boomers, which have typically been retiring between the ages of 65 to 70, are actually retiring between the ages of 55 and 60. So that is reducing the labor force quite rapidly. Secondly, because of the pandemic, we've decreased our immigration rate by a very significant amount. So that is to say, we are taking in much fewer younger bodies that would have added to labor, thus bringing down wage inflation in a sense. So sitting today, because of this labor tightness, what we are seeing is that wage inflation on average is running at about 5.7%. And if you look at it over the last year, all the airlines have given very significant wage increases. Recently, UPS drivers got a very significant wage increase. And come September, the 3 auto unions are negotiating for a wage increase very similar to UPS in a sense. Now, this is not unique to the US. It is actually prevalent across all the developed markets because they have very similar demographics in a sense. What I would say is that Europe and Japan actually have worse demographics compared to the US. So because of the core inflation, we expect inflation to remain somewhere in the 3 to 4% range for the foreseeable future. Now, let's shift our focus a little bit to the fiscal side of things. So at the beginning of this year, we passed the Fiscal Responsibility Act. And the first thing worth mentioning is that we did not raise the debt ceiling. We actually suspended the debt ceiling. So that gave us a message that we will be running very high deficits. So sitting today, the 12-month lagging deficit is a humongous $2.8 trillion. Now let's put some context around it. So 2.26 trillion is 8% of GDP. Now, when we look at the last 100 years, the typical average is about 3.2%. So during the expansion phase of the economy, typically the budget deficit is about 2 to 2.5%. Then when we go into recession, typically it expands by about 6 to 12%. That gives us an average of about 3.2%. So running a deficit of 8% during good times when we don't have a recession is unusual and extremely large. So what is happening in practice? So in practice, the politicians are running a normal deficit of about 3% of GDP, but they continue doing a fiscal stimulus of about $1 to $1.2 trillion. Now, there are several components to that fiscal stimulus. One of that is actually the increase in the interest expense of our debt. So when interest rates were at zero, we were spending only about $350 billion on all of our debt. Now with the Federal Reserve increasing rates, we are spending literally an additional $500 billion in terms of interest expense. And if we remain at these high rates, very likely the interest expense will go beyond $1 trillion by the end of this year, in a sense. So that is something also quite important to keep in mind. Now, with all of this put together, the moment we say that there is the likelihood of a recession taking place, most of you, when you hear the word recession, you will start thinking about 2008 and 2000. Now, recessions can come in very different forms. And our expectation is that this recession is going to be very different from the 2008 and 2000 recessions. Now, why do I say that? The reason being the labor market today. So during 2000, 2008, what we saw was that there was plenty of labor and corporates were eager to lay off people very easily. And once you start laying off people, consumption in the US economy, where 70% of our GDP is driven by consumption, that starts to react. So sitting today, when we talk to CEOs, what they tell us is that if I need a person over the next 18 months to 2 years, I'm actually going to keep them on my payroll and actually take on losses in a sense. So what you're seeing is a little bit of labor hoarding taking place by corporates, simply because they understand the labor market is going to remain quite tight in a sense. On the other hand, what that means is that profitability actually starts reducing. So we've seen both of these things actually play out over the second quarter. So let me go and talk a little bit about the earnings and the valuations in the market today, and then we'll wrap it up with our asset allocation. So sitting today, when we look at the last year, and I'm talking about since July of 2022 to June of 2023, what we see is that the S&P 500 revenues only grew by about 0.6%. Now, some might say that's very good growth when we were expecting a recession. Well, what we would say is that nominal GDP growth was actually around 6%, and this is very weak revenue growth. So what is happening? Two things are happening. One, the consumer is starting to run out of the pandemic savings which were given during the fiscal stimulus packages in 2021, 2022. Secondly, corporate spending, especially on information technology, is starting to weaken at the margin. And then when we look at earnings, it becomes very clear that earnings are actually down about 5%. Now, earnings are down, as I said, because companies are preferring to keep labor on their payrolls, and they're compromising on pricing as well as margins in a sense. So sitting today, let's look at valuations. So S&P 500 earnings, before I get to the earnings, let me describe what you're seeing on the screen. So on the x-axis, what you're seeing is the P multiple for the S&P 500. So it goes from 16 to 22 in a sense. On the y-axis, what you're seeing is the earnings per share. So it's going from $200 up to $240. So over the last year, the S&P 500 has generated $212 in earnings. Now, sitting today, it is trading at 4,500. So what that implies is that it is trading at a P multiple of about 21.25 times. Now, we could justify this multiple if there were two conditions. One, interest rates were at 0, and inflation was only 1%. Sitting today, what we notice is that interest rates are actually around 5.5, and inflation is around 3.5 in a sense. So when we look at history, what it tells us is that the right P multiple should be around 17.5 in a sense. So yes, this is a slightly expensive market. Now, let's look at the global picture. So as I mentioned, the US is trading at about 21.25 times. When we look at developed markets, which is nothing but Europe, Japan, Australia, Canada, they are trading at a P multiple of about 12 times in a sense. But what is really cheap to us is emerging markets. So emerging markets are growing at around 4.5% compared to the US at about 2%. Developed markets, I would say flat to slightly positive. So I would put it around 0. So when you look at valuations relative to the underlying growth, emerging markets also look quite cheap to us. So putting all this together, I would say from an asset allocation perspective, we are looking at a slightly defensive stance. There are some better valuations in the fixed income space, especially when the Federal Reserve is giving you 5.5%. And when I say fixed income, there might be a few high net worth individuals. So municipal bonds also look quite attractive to us in a sense. And then on the equity side, I would say two things. One, you need to focus on high quality corporates. And the second thing I would say from an opportunity perspective, emerging markets look cheap to us in a sense. So let me stop there. And Laureen, Carissa, John, if you have any questions, we can take on some questions.
Thank you so much. Thank you so much for that overview. Thank you so much for that overview. And Chris, is everybody else muted on our call?
Yes.
Okay, great. So just a recap there and saying that we do agree that the economy is slowing down. We do agree that we're heading towards a recession, and that doesn't mean that it's going to be catastrophic. It doesn't mean that we need to be fearful, just like Nosh said. So, but it does mean that we are becoming more defensive. And with that, we would also agree that keeping fixed income in the high quality space is very important, because what happens as you head towards a recession, it's the areas that are lower quality that get hit the hardest. So with that, we're increasing credit quality, keeping that high credit quality in place. And then when you compare on a taxable side, as far as fixed income, and you compare municipals and what's being offered in treasuries, you actually make more in an after-tax situation for the highly compensated people, high net worth. You're going to be compensated more in those municipals than in treasury. So there are a lot of people that are flocking. We know how much money is going into money markets, and money markets are great in that they are liquid. And so for liquid money that you may need in the shorter term, great avenue. We had a webinar on that last month, talking about money markets, or 2 months ago. And we did talk about money markets, and we are helping our clients by utilizing money markets for liquid money that you may need in the shorter term, that might be just sitting in a savings account, really not doing much. That's where money markets, that's where that money belongs. But municipals, as far as having that tax-free, and when you use your state's municipal bonds, you're going to be able to save quite a bit of money there. So that's on the fixed income side. On the equity side, historically, when we talk about becoming more defensive, we talk about capitalization. We talk about large cap over small cap. So that's the traditional thought process when you talk about an economy slowing down. And then the other part is looking to value. Having said all of that, that doesn't mean that you shouldn't have some growth positions. It doesn't mean you shouldn't have some small and mid-cap positions. But it means that as far as weightings are concerned, we're looking at those weightings in the portfolio as to how much should be in the larger cap versus small and mid, how much should be in growth versus value. So we're looking at all of those across the board on our portfolios. And we're taking care of those things and becoming, a little bit more defensive. With that, John, do you have anything more to add before we then open up to some questions? We're going to be sending out our letter here soon, as far as coming from us, as far as our perspective as well. But John, anything else that you want to offer?
No, absolutely. I mean, you covered all the topics. I mean, we saw that value in a few spaces has been hurt year to date, specifically within financials, and then with the, commodities coming down the first half of the year affecting energy. But, this is going to be an area where you can potentially brace a little bit more as things gets a little bit worse. Like I said, mild recession. But again, yeah, you covered all the topics.
Okay, sounds good. So with that, if you have a question, you can raise your hand, the virtual hand that you have there with the Zoom. So Krista, do we have anybody that has raised a hand, asked any questions yet?
I don't see any. Oh, just kidding. There we go.
Okay, good.
Howard has a question.
Great. Hi, Howard.
Oh, and let me unmute you.
Oh, okay. There you go. Hold on. There you go.
Yeah,
there you are.
There. Hey, great presentation. Thank you. Just length of this as you talk about it. Are we talking a 2-month, a lot of reading of September, October could be tough months of looking at, or are we talking a 6-month stretch here? What are you guys thinking of how long this stretch will go before we break out and you can say, hey, we're out of the we'll use the word recession, but we're out of where we think trouble and the things start getting a little better?
So I would say what we are looking at is the economic weakness to start manifesting itself. And I want to separate the economic weakness from the market weakness. So we are expecting the economic weakness to come about sometime in the fourth quarter, and then possibly going towards, I would say, middle to end of the first quarter in a sense. Now, in terms of market weakness, very difficult to predict. Firstly, whether it actually happens or not. And secondly, the magnitude of it.
So with that, Nosh, you know what, could you put up your presentation again? There were a few slides in there as far as why you don't want to be out of the market. And is that part of what, do you have those slides in there?
Let me see, I might have it in a different, so.
Because
Might have
one
it.
of them that I was looking at, it was, you know, one of the things is, you know, the consensus is we're heading towards a recession, right? But
Yes.
but once again, for those of you who heard our year end last year, we said we think the market is going to be stronger than people are anticipating, and it was. So as much talk as there has been about a recession, we haven't gone to a recession yet. And the market, as you know, has done very well year to date. So that's where, as far as being in the market is concerned, you have to be careful not to be out of the market, because the markets move in very quick increments. You cannot time it and get back in. So therefore, it's a matter of making sure we're doing these changes that I was talking about, looking at asset allocation, how we can be tactical, but not being out of the market and then trying to get back in. So with that, Howard, you know, it is hard to predict as far as volatility. What I will say is, and what you've probably been reading is, there's the seasonality of the markets. And seasonality tends to be that September, October can be difficult months in the market. That's just, historically, they can be difficult, but not always. So it's not an always, but it happens quite a bit. So that may have been what you were reading. With the uncertainty still as far as what the Fed is going to do, and how much more they're going to raise rates. But I will say that our opinion is that we're pretty much done. We're pretty much done with raising rates, or pretty close to it. So when we look at that spectrum of from the time that we started raising rates to the end of raising rates, we're certainly closer to the end where they're going to pause and they're going to hold. So, you know, and if we look at what the markets are actually pricing in, the markets are actually pricing in most likely no rate increase in September, and then maybe one more before the end of the year. But therefore, you know, they're going to then pause and leave those rates higher. Like Nosh was saying, leave rates higher for longer and let it really take effect in the economy as the economy continues to slow down. But with that, once again, can't really tell on the markets. Some recessionary periods are shorter, some of them are longer, but in a mild type of recession like we're expecting, don't expect it to be a longer period of time. And then we just don't know how much has already been priced into the markets as far as the economy continuing to slow down. But having said all of that, expect volatility. So we're not done with volatility. I will say you have to expect volatility and therefore be mindful that there are downside risks. So once again, any kind of shorter term money, making sure that that's more conservative, and then your longer term monies, letting that continue to be, you know, for the long haul. So just as we do, we allocate portfolios based on risk tolerance, time horizon, looking at all of those factors. So hopefully that answers your question, Howard. Any other questions? Carissa?
That's it. Howard, I think your hand is still raised. I'm not sure if you have another question.
I think you might need to unmute him if he needs to speak.
I am good, thank you.
Okay.
Okay. Okay. Well, as always, any questions that anybody has, please let us know. We're here for you, to meet with you, to review your own situation. And we appreciate you participating in our monthly webinar. So with that, thank you, Nosh, for participating.
Thank you.
And we'll see you next time.